Welcome to Your Money Guides, brought to you by Interface Financial Planning. Hello. In this episode, I want to talk to you about how to invest for income in a low-interest environment. In this guide, I'm aiming to help investors who are primarily looking for income from their investments and savings, as opposed to capital growth. In this respect, financial planning and investment is largely about finding effective ways of providing income from any capital employed. Income may mean different things in different people's hands, so we need to be careful about employing broad brush statements in this quest. However, across the board, any means we can find to improve income prospects should be pursued. My objective is to help you find the best income solutions in the current low interest rate environment, regardless of your position relating to the risk you are looking for or able to take with your capital, your wider objectives, or your tax position. I aim to cover each position you may be in at the current time within this guide, and to show you how you can generate a decent income even though interest rates are at such a low level. The current Bank of England base rate is 0.1%. It was cut on the 19th of March 2020, just a week after being cut to 0.25% from the 0.75%, which it had been since the 2nd of August 2018. This historic low in base rate is to help bolster cash flow for households and small businesses affected by the coronavirus pandemic. Interest rates have been low since August 2016. This has meant returns for savers have effectively become negative. This is one of the longest periods of real negative return since records began, and there is no obvious sign that this trend is set to reverse anytime soon. The implication for savers is clear. Savings accounts are in poor position and no longer represent a viable home for savings which are required to produce an income. Compare this with 1990, for example, when savings accounts would produce interest rates of around about 10%. At that point, savings accounts were able to generate the income most savers needed and required. The interest rate level is expected to return towards its average at some point, and when this occurs, savings accounts may once again become part of an income-producing landscape. However, there is no indication that any increase is likely in the near future. Savers cannot wait indefinitely, and income portfolios need to be constructed based on known facts of today's rates and levels. So what income-generating investments are available to you? There are many different investments that generate income, and the good news is for income investors is that many of these are capable of providing much higher income levels than a savings account. Furthermore, some of these are either unaffected by the general base rate or may even benefit from it. Unfortunately, these alternatives don't necessarily have the same level of risk on the capital invested. This means investors may have to pay careful regard to the risk-return position on any investment used to produce an income. There are four main income-generating investment options from the four major asset classes. These are savings accounts, normally described as cash, fixed interest investments, shares, and property. I will examine each in turn. Firstly, let's look at savings accounts. These are bank accounts, building society accounts, and other cash accounts, for example, national savings. As an asset class, they are known as cash, and their characteristics are that they offer a risk-free home for the capital placed into them in return for an interest rate. The level of interest payable will be closely linked to the general base rate. Although described as risk-free, they do have some risk in the sense that when interest rates are lower than inflation, the saver will be losing capital value in terms of the purchasing power of their money. The inflation rate will be eroding the saver's capital. And there is always the risk that the bank or building society will default or fail, and the capital could be lost as a result. However, in the UK, there are substantial guarantees in place to protect against this. In all other respects, it's accurate to consider cash accounts as risk-free. So now let's look at fixed interest investments. There are many types of investment that will fit into this category. I will consider just a few of these within this guide to highlight the main features and factors that exist. The most popular example of fixed interest investment would be government bonds. In the UK, government bonds are known as gilts, and in the US they are known as treasuries. They are fairly simple to explain. The government issues a bond and investors purchase them, handing their money to the government. In return, the government promised to pay the money back at a fixed point in time. In the meantime, they pay the annual rate of interest. For example, a 10-year gilt may be issued offering an interest rate of 4.5% per year. This means that an investor subscribed to such an issue would subscribe a sum, say £10,000, and would receive 4.5% per year in interest, or £450, knowing they would get their capital back in 10 years' time. Government bonds tend to offer slightly better rates than cash, mainly to incentivise investors to take the additional risk that they pose. Bonds of this type are considered riskier than cash because they are a promise, and if the government fails to meet their promise, capital could be lost. This can and does happen, as has been evidenced by many governments worldwide over time. Such events are known as defaults. The general trend is that the safer the government, the lower the rate of interest they will have to offer. This is why there has been such focus on credit ratings, because it's perceived that the credit rating indicates a sign of the strength of the issuing body. A good rating indicates that they should be good for their promise. A low rating makes it less likely. The other big fixed interest instrument is a corporate bond. A corporate bond is virtually identical in structure to a government bond, except they are issued by companies, hence the name. They will typically pay a higher rate of interest than a government bond, simply because they are another notch up the risk scale. Companies are more likely to default than a government as a general rule of thumb. Bonds can be traded. They do not have to be bought on issue or held to maturity. They can be bought and sold throughout their period of time between these 2 points. However, the price of a bond can fluctuate throughout the period, and this can mean that the bonds have a risk to the investor's capital. There are many other fixed interest investments. An example would be permanent interest bearing shares, or PIBs. These are issued by building societies. As their name implies, strictly speaking these are shares, however their structural nature is more akin to a bond. PIBs pay a fixed rate of interest or an income to investors, and this income is generally fixed, but unlike bonds, they have no redemption date, although there is normally a cancellation date which allows the building society to cancel them. PIBs can be bought and sold on the stock market. They're not covered by UK compensation schemes. Although they can look attractive in terms of the fixed income payable and are often considered low risk, these other factors that I've mentioned need to be taken into account and balanced against the possible benefits. So now on to shares. Shares in companies will normally offer investors the chance to receive dividends. Dividends are paid out of the profits made by the company. These payments are most often paid to investors twice per year and will be dependent on how well the company performs. Buying shares in a company is a risky venture because the share price can fluctuate and the dividend payment may also go up and down and possibly disappear altogether. A company could go out of business, making the investment a high risk. The upside, however, is that dividend payment levels are generally disconnected from the base rate and tend to have a higher, sometimes much higher percentage level than cash alternatives. There is also the prospect of decent growth in the amount of dividend payable year on year, offering the possibility that the income level can keep rising. The company share price could also rise, which could provide a win-win situation, a higher income plus a profit on the capital amount invested. Now let's look at property. Property can generally be classed into 2 separate categories: residential property and commercial property. A residential property can be bought to let out, with the rental income acting as the basis for an income payment to the investor. Likewise, a commercial property, such as an office, factory or warehouse. These can be bought and owned in the same way, with the rental being paid by the tenant or the business that rents or leases the property being the income payment to the investor. Rental income is unlikely to be tied to interest rates. The level is probably going to be much higher in the current environment. As with shares, there is an issue around the capital value of the property owned, which could go up or down. Similarly, the rental income could be unreliable or fall. Therefore, property investments have the same hallmarks as shares, offering the potential for much higher income than cash, the potential for growth in the capital value of the asset, but inherently much riskier overall. Property has another risk factor. It's deemed illiquid. This means it can be difficult to sell a property quickly, and in very bad markets, it could mean not selling it at all, leaving investors stuck if markets turn and they wish to exit their investment. So these are the main asset areas and the characteristics of each. The areas offer different income prospects, different positions with the risk attached, and variable prospects on the potential capital return. The core understanding of each investment and their structural nature is a crucial start point. However, there needs to be some serious application towards the details, because it will be the details which provide the solutions to anyone seeking to improve their income and to get a good income, almost regardless of the prevailing environment. There are many different individual investment types that investors may use in creating an income portfolio. However, the greatest challenge for investors is not the choice of these individual types, but the construction of the right asset allocation mix to meet their needs. So how do you invest for income? The asset areas I've just described are considered the main income producers for anyone looking to generate an income from their available capital. There are other possibilities, but these are generally esoteric in nature. This does not mean that they should be discounted, but it's probable it will be one or a combination of these mainstream assets which are utilised. If this is the case, then there are several questions which need to be answered before any structure can be applied. Some of the key questions are: what income level is required or desired? What risk can be tolerated? How important is capital growth? What is the tax position? And also, how is the income required and how often? This is the fact-find element, the part of the process which creates the overview of the investor's required position against their current and future situations. This is going to be the most important factor, determining the levels and parameters for which the income portfolio can be constructed. Different combinations of different types of investment will be appropriate, depending on the individual's requirement, overall financial and tax position. Amongst the fact-finding, there has to be careful appraisal of risk. For example, investing in shares has proven to be one of the most dynamic ways of generating income. The current position at the end of 2020 has dividend levels from the UK shares averaging 3.7% per year. This is based on the FTSE 100. This is compared to cash returns, which struggle to get above 1.5% per year. Shares are producing around 2 to 2.5 times the level of income. Indeed, with careful selection of high-yielding shares, the percentage could probably be lifted to close to 5%. UK shares offer investors two further tempting possible advantages: dividend growth and growth on capital invested. A cash account has no capital growth possibility. Without a risk factor, the use of shares is clearly a better prospect. However, as I stated earlier, shares do carry a risk, and the trade-off is between the prospect of extra return and the added risk. The risk is, to a significant extent, measurable, through a number of methods. Although it can be measured and assessed, this still only helps to a limited degree, because the risk can only be positioned as a factor of a number of future possible outcomes. Using a simplistic example, if there is a 10% chance that the shares used to generate income may fall by 35%, the investor cannot know what is going to happen. Is the 90% possibility going to occur, or the 10% possibility? Assuming the risk can be assessed accurately, then the issue becomes one of risk tolerance. This is a very important word, because for decades everyone used to focus on risk attitude. The reality is that the investor's attitude to risk is not especially important from a financial planning point of view. Their tolerance to risk is the important factor. If the investor cannot tolerate a 35% drop in value because it would create havoc with their finances, then the investment is not suitable. All of the income areas need to be assessed this way, and a healthy regard for mixing and matching the risk of each investment or asset area considered against the investor's own risk position, as dictated by their ability to tolerate losses, needs to be taken. The steps in creating an income structure need to start with a fact find, and then a full assessment of the risk as I've described needs to be undertaken. Once this has happened, then an income portfolio can be structured. So let's now look at creating an income portfolio structure. The asset areas I've already mentioned, cash, bonds, shares and property, are quite easy to widen simply by splitting bonds into government and corporate bonds, shares into UK and overseas shares, and property into residential and commercial property. It's possible to go even further and look at smaller company shares and larger company shares. Although the asset areas may at first glance look narrow, they do have breadth beneath their headline titles. The critical aspect of creating a portfolio is to take the two steps I've already mentioned, the fact find and the risk assessment steps, and then start marrying these against the income structures, of which there are many variations that could exist. The structure used should be the nearest match to the income required and the risk tolerance. The structures will mix the asset classes to balance the risk and reward in line with the investor's requirement. This is known as asset allocation, balancing out the different asset classes in different proportions to match the required position. It's important to note that any asset allocation breakdown must only be considered on an individual basis and after appropriate steps have been taken to analyse individual circumstances and requirements. There are other factors that I've not yet covered which need to be brought into the equation. Firstly, correlation. Any asset allocation split has to be considered with high regard for correlation. This means that an ideal portfolio will mix the assets in an attempt to ensure that the returns are as loosely correlated as possible, so that if one area used is performing below expectation, another area will hopefully be doing better. Historically, different asset classes have performed differently at different times. It's important to avoid correlating assets too closely together, otherwise they may move in the same direction, causing unwanted losses or difficulty. Through careful correlation, the overall risk of any portfolio can be reduced. Secondly, there's tax. The asset classes which make up the asset allocation, which in turn will determine the portfolio structure, could be influenced by tax. Different asset classes have different tax treatments. The growth on shares and property is classed as a capital gain, and in the right circumstances, investors can use these gains within their annual allowance against capital gains tax to generate a tax-free return. Also, the rate of capital gains tax may be lower than the income tax rate for a particular investor, or it may even be higher. Tax factors can influence the mix of assets used. And finally, there's investment vehicles and funds. Most investors don't invest into asset classes in a direct fashion, preferring instead to use investment vehicles such as ISAs or investment trusts as a means to gain exposure to that asset class. The use of such vehicles and funds is an important consideration, once again providing an element of risk reduction. For example, if you are inclined to invest into government bonds, it may be more prudent to invest in a fund, which in turn invests into a range of government bonds. Not only is this generally more convenient, it also allows investors to diversify their holdings across many individual bond types. There are practical reasons as well. Many investors who want to invest in property simply don't have the available money to buy an individual property, or the expertise or even the time to manage their own property. However, a property fund allows an easier and lower entry point, allowing the investor to access the asset class without having to buy the asset direct. The choice of which vehicle to use and which funds, fund managers and type of funds is an important and influential part of the process. So in summary, if you are looking to invest for income, there is no reason to allow the current low interest rate environment to depress you. Income can be generated from many asset classes, and the level of income from some of these remains very competitive in relation to the current inflation level. The higher risk attached to these better income producers can be managed if you follow the steps and processes outlined in this guide. We are here to help you do this. Thank you for listening. For more information, visit our website at interfacefinancialplanning.co.uk.